Hey guys, it's Henry, and in this video I want to talk about the market and what I'm doing in the market right now with my trading. So on March 10th, Silicon Valley has distributed a lot of bonuses to 8,000 employees, and later that day, the bank failed. SVB was the bank of choice for much of the tech sector, especially the tech startups. And almost half of all the venture capital funding in the US flowed through the bank. Adding on top of one bank failing and potentially others to come, we have a Federal Reserve meeting that can influence the market significantly. And the Federal Reserve is expecting to raise inflation rates slightly, and I believe it's going to be by about 25 basis points. The Federal Reserve is trying to combat inflation, but recent bank closures and government rescues have made the decision more complicated. Looking at my portfolio, I have a lot of positions in trades that I want to talk about today. Things are certainly not looking that great. It's kind of looking like a rerun of 2008, and it looks like taxpayers are going to bail out the banks again with our taxpayer money. So as I mentioned, I am expecting a 25 basis point increase, and I think that's going to have a significant impact on the market. However, which direction, I am going to be honest, I have completely no idea, and I don't think anyone really does. But I do have a plan using options and slightly different option strategies to make money in this market right now. And the crazy, unbelievable thing is, as someone who has a finance degree and has studied interest rate risk, things are not really looking good, to be honest. It's frustrating to see many bankers and examiners underestimating its importance, and that's essentially what happened to SVB. A bunch of smart people underestimated what can happen with interest rate risk. It's alarming to see this playing out in real time, with the FDIC having to step in to address bank closures and financial instability. So as you guys probably know, I use a lot of tech stocks. I love tech stocks, and I have been selling options consistently to make income on tech companies because that's my area of expertise. I used to be in the software industry. So for me, I love tech stocks, but to be completely honest with you, when inflation goes up, that is actually not that great of a thing for tech companies. It's typically very good for energy companies. It's also very good for utility companies, material companies, industrial companies. Those type of companies fare a lot better. Specifically, honestly, just energy companies fare the best when inflation is going up, because it's very easy for these companies just to quickly turn on a different price, and there you go. Consumers are going to be paying more for electricity, more for oil prices, etc. And a lot of different companies that are high growth, specifically tech, typically does suffer. Again, with energy, commodities, fuel prices, all this stuff can adjust very easily. However, with tech companies, that is not the case. For example, Google, they make most of their money, and YouTube, for example, puts ads on videos, and these ads are okay, but the people spending money on ads also have a problem when inflation goes up because they have less money to go around, and it's not like YouTube can necessarily raise prices on their ads without the advertisers actually willingly paying for these ads. So just as an example, Google's going to get affected, Meta's going to get affected, Amazon will also be affected because as goods are getting more expensive, people cannot do as much shopping. I know we all love our new package from Amazon every single day, but for the people buying 8 packages, maybe they're going to have to start buying 7 or 6 packages because of inflation going up. And to be honest, I was thinking about buying financial companies, and I am so happy that I did not buy any financial companies, because typically financial companies actually do very well because they're able to raise interest rates and pass on the cost to consumers. For example, when you're buying a house, mortgage interest rates are now 6.5%. So if you're looking at that Florida property like I am, things are way more expensive and consumers cannot afford as much house as they used to. And that's why for 2 quarters in a row, housing prices have actually not increased. But typically, financial companies actually do really well. But if you will look in my portfolio, I do not currently have any financial companies except for one, and that is going to be American Express. And the reason why I have American Express right here, actually, is right in front of my eyes at the 150 put, is because American Express has a fantastic brand. So I want to start acquiring some financial companies without actually having an exposure to banks. Now, American Express does have exposure to banks. However, if I'm going to pick one financial company out there, it's going to be the safest one that Warren Buffett also owns. So I want a consistent compounder. So for me, I started to add a little bit of financials as they have sold off a lot. I mean, we have seen FRC completely crash, as well as, actually, let's take a look at XLF. This is actually one of my favorite SPDR ETFs. I really like SPDR because they basically have a lot of different ETFs, and within this ETF, they have a lot of different holdings. So I like XLE for energy, XLF for financials, XLY for consumer, XLK for technology. So I'm looking at XLF right now, and if we look at the 1-month chart, this thing is down 13%. I mean, these are some of the highest quality companies: Berkshire Hathaway, JP Morgan, Bank of America, Wells Fargo, Morgan Stanley, Goldman Sachs, where I used to work at, BlackRock, right? So many of these financial companies are behemoths and giants, but they have been affected by 13% drawdown in the past 30 days. But for me, American Express, I think, is one of the best companies that you can buy right now. And as you can see right here, it's only down 9.84%. So as a financial pick, I'm putting a small amount of money in American Express. But other than that, actually, guys, I'm still in technology. And I actually think because technology has sold off a lot, and because the market is very tricky and completely random, you can't time the market, you don't necessarily know which sector is going to do well. In my opinion, in my educated opinion, right, I actually am a fan of technology companies. So I have recently sold a put option on Apple. For me, when I'm selling a put option, I'm saying I'm ready to buy shares of this company. I'm ready to invest in this company and start buying some shares. So I have sold one put option on Apple stock. I also have BABA, which I'm absolutely killing it on with BABA, Palantir, and QQQ. So for me, I like Triple Q. Specifically, a lot of my students are doing zero DTE strategies. And I think that's a really good strategy right now. I'm a very big fan, especially as we see all these bankruptcies potentially coming. We see inflation going up. We see potential interest rates going up. We really don't know what's going to happen in the market. And for that reason, I am actually a very big fan of weekly trading and even shorter term trading, like 3 days, 2 days, or 1 day, which is 0 days to expiration, basically same day expiration. This has become one of the most popular chats within my Discord, in my community. And I think that's for a very good reason, because my members are very smart. They know what they're doing. They're educated. They know my strategies. And basically, I can see based on other people within my community that, hey, we don't want to hold positions for, a week or a month, or heck, even overnight, because we don't know what's going to happen right now. So that does make a lot of sense to me. I'm not fully utilizing this strategy as it is a lot of extra work, and I still prefer to have passive weekly income. So I am still going for technology companies, as you can see here. This is Adobe. I have actually bought a little bit of a debit spread. Now, I know that's very weird of me. I usually don't buy options, and it's very rare, but I have recently made a video about buying options. If you haven't checked it out, it's right here. Here's the thumbnail. But I do believe right now, as you are profiting by selling options, covered calls, spreads, all of these other strategies like the wheel, which I think the wheel is still one of the most safest strategies out there. As you are making this cash flow income, I do think that you should allocate some of your cash flow and some of your profits to buying strategies, because this market is going to experience a lot more volatility. I have no doubt about it. The market's pretty much always volatile except for 2021 when the market was just a straight line upwards, but we are not in that market environment anymore. We're not even close to that market environment anymore, with inflation going up, with bankruptcies, and I'm pretty sure we're gonna have a new crisis around the corner. There's always like a new crisis every single month. There's a new issue, and whenever a new issue comes out, there's volatility in the market. So right now, I actually think it's one of the smartest times to be buying options. But again, look, keep in mind, risk management, okay? So if you have $10,000, you should be using about $9,000 to $9,500 of selling strategies where you're making consistent, passive cash flow. And for the rest of your money, like $500, go ahead, buy with that amount of money. But don't buy with like 20% of your portfolio. I've been doing this for a very long time. For me, it's basically just sell strategies. So I have Apple, Adobe, I actually bought an option. American Express, I'm starting to get into financials just a little bit. BABA, Palantir. Palantir has been just a cash flow machine. I've been selling puts on Palantir, covered calls, the wheel, just over and over and over. It's super easy to make money on Palantir, especially around the 7.5 strike price. I mean, Palantir has just sold off so much. I do think that it is a value play along with NEO. A lot of my students are selling puts on NEO. I think NEO is a very good play right now. I do believe I have it in my portfolio, and if I don't, I had it expire on Friday. So if I actually open up my NEO position, I've been selling a lot of put options, and I need to sell some more put options. In fact, if the market wasn't closed, I would do that right now. But yeah, as you can see here, I was selling the $8 put on NEO. I made $34. As you can see right here, it's $17 per contract. So when I collect basically 17 bucks on 800, that is a 2% return. It's actually slightly higher than 2%. It's like 2.2% return. And this just expired on Friday, and I need to open up some more tomorrow. So what I'm likely going to do is just sell some more $8 puts. And for me, this makes a lot of sense because as you can see, there's a lot of support for NEO, like around $18.18, $18.15, $18.15 again. We had a little bit test higher where the stock was trying to go a little bit towards the $9 range, and it did go to the $9 range, but still, as you can see, there is hard support at $8.25. So for me, selling the $8 put is a no-brainer. And if I go to the 3-month chart, I don't even see this stock going below $8 per share. So if I can collect 1%, 2% per week, heck, 1% per week is plenty, because a lot of people, they are working with $50,000 or even $100,000. So 1% a week on $100,000, that's $1,000 easy. So if you can make $1,000 easy per week consistently for 52 weeks a year, that's $52,000. That's basically, that's a pretty good salary right there. So as you compound your portfolio, it's not really that hard to make $1,000 a week or even $2,000 a week, right? So for me, NEO should be a component of that. Palantir, NEO, these are also fantastic small account plays as well. But I think the perfect range to, be trading with is $5,000 to $10,000 and then scaling from there, hitting the 50,000, 100,000, $250,000 mark. It just takes time. It's just a matter of time. It's not if, it's just when. Okay, so QQQ, I'm also doing put credit spreads. So I love spreads, and I made a whole video on spreads you can check out right here. The most detailed spread video in the entire planet Earth is basically about how to be consistent with put credit spreads. That's what I prefer. Okay, there's a lot of different spread strategies. There's 4, right? There's 2 different debit spreads, which I typically don't really do. I only have a debit spread right now on Adobe, and I actually have a debit put spread where I'm betting on Tesla falling down. And so far, it's not doing that well. It's down $449. So as you can see here, that's the reason why I don't prefer buying strategies. Every time I buy, it just ends up being a loss. Sometimes it ends up being a big gain, but it's really not consistent, and I'm not really about that life. I want it to be consistent cash flow, so I don't need to get a job, but I can just keep traveling and enjoying life. And that's the most important thing for me. That's why I focus on folks just making $1,000 to $3,000 a week. If you can hit that range, you're good. If you can do that 6 months in a row, you're good. You don't need a job. You don't need to go to an office or anything like that. So that's why I'm really focused on just diversifying. I think that's the most important thing that you could do in this market, right? For example, financials are supposed to do well. They're not doing well. Technology is not supposed to do well. It's doing okay. So what you want to do is you really want to diversify amongst different sectors, but within those sectors, you really want to understand fundamental analysis. So one of my biggest secrets for fundamental analysis is essentially I want to pick stocks that don't have a high price to sales ratio and don't have a high price to earnings ratio. So I actually want to give you a quick lesson on both of those things, because if you understand this basic, just super simple, might take just a couple minutes. If you understand this, you are going to make way better decisions. So for example, I ended up making really good money on Snow before with call credit spreads. That's basically saying that I don't think this stock will go up. And a lot of my members at first, they were like, this thing's crazy, it has huge momentum, why would you do this? But we ended up making a lot of money on Snow. And the reason why I did this is because if you go to Yahoo Finance and you go into the statistics tab, check it out. The forward price to earnings is 222. For you to understand what that means, this would be the equivalent of paying $222 to make $1. Imagine you have a property that's 220 grand, right? You bought a house and it's making $1,000. Not a month, a year, $1,000 a year. That is absurdly low, okay? That's basically where Snow is right now. You're paying 222 times more than what it's making in its earnings. It makes no sense at all. In my opinion, overvalued stock completely based on price to earnings. Now, if we look at price to sales, 21. Now, what does this mean? This means price that you're paying for the sales. That just gross sales. That's like if they make $100, you're paying 21 times that. But that's not what they take home. They clearly take home very little. Like if we look at the balance sheet, we go to financials, right? We look at the income statement right here. Their total revenue is good, right? But if we go down to, it's actually on the cash flow side. So we go to cash flow, their cash flow is super low. I mean, it's negative here, right? Free cash flow, it's $495 million, okay? But that's not a lot because a value company, $495 million would be 10 times free cash flow. So at $495 million, this would be about a $4.9 billion stock. That would be a value stock, 10 times free cash flow, okay? When I was taking all my finance classes, it was kind of interesting. This hedge fund manager came in. He drove a Maserati, which at the time I was like, oh my God, this guy's stupid rich. I was like looking up to him like crazy. There's nothing wrong with Maserati, but I looked at him like a billionaire. I'm like, holy moly, this guy's smart. And he was. He learned all the Warren Buffett strategies like buying stocks at a discount. His license plate was 10 FCF, which is free cash flow, okay? Something like that. I don't want to say his exact license plate, but it was like 10 FCF, something along those lines, okay? So it was like 10 times free cash flow, and that's how this hedge fund manager made a fortune, right? He bought cheap companies, and that was his rule. You find companies that you can buy at a discount, right? So like I just said, a value for Snow would be 10 times free cash flow of the $4.95 billion. So that would be the value. Snow is worth $43 billion, 43, it's 10 times overvalued. But again, of course, it's a tech company, but still, looking at this kind of company, this is the exact company I would avoid and I would do call credit spreads on, and I made a ton of money. Call credit spreads, I am a little bit afraid of it at this point because it's volatile. But before, I think this was in November I was trading it. November. So yeah, it's been a pretty easy bet to bet against. So for me, I always want to look at price to earnings and price to sales. And just to compare this, you're probably thinking like, well, 21, I'm not sure. Is that good? Is that bad? Is that Henry saying that's high, but how high is it? Well, let's just do a comparison to Tesla stock. So for example, like Tesla stock, it used to be 21 price to sales, which was really high. And recently it was 11. And actually right now, because I just looked at this recently, I know it's at 7.38. That is really, really good. It's actually a very good sign that Tesla has finally stopped being an overvalued stock. It's no longer super overvalued. At 7.38, this is very good. I mean, this is actually, to be honest, it's like Apple territory. Now, Apple was around $7, I think, 7 price to sales at its peak. I wouldn't be surprised if it's a little bit lower right now. Yeah, it's 6.29, but essentially Tesla is barely more expensive than Apple. And for me, this is a very good sign that the tech sector is not overvalued, that there's actually some decent deals in the tech sector right now. And for me, I think that doing covered calls on technology makes a lot of sense. I think selling puts makes a lot of sense. In fact, I would be selling puts around 20 delta, 25 delta on technology companies like Apple, Tesla. I haven't been in Tesla for a while, but I am starting to really warm up to Tesla, especially because just looking at the fundamentals and the valuation, it's starting to make a lot of sense to me. As well as other companies like American Airlines. American Airlines has come down a lot. I mean, this was a $16 stock and now it's under $14. So if we go back to my portfolio, I am selling 13 puts somewhere on American Airlines. Yes, 13 puts. I'm up a modest $20 so far, it looks like. That's not a whole lot, but I expect American Airlines to remain above 13 per share, and it doesn't go below, I'll be fine, right? If it goes to about 13, I may think about rolling out to potentially 12, but to be honest, I love to stick to the wheel strategy. Very simple. When I sell a put option, I'm happy to buy the stock at that price point, at the strike that I'm picking. So for me, if American Airlines goes to $12.50, I'll be more than happy to take ownership of the shares, get a sign, right? Get exercised on that Friday of expiration. So that would be on April 21st. And then on that Monday, I'm gonna wake up, be pretty happy when the market opens up. I'm gonna go ahead and start selling covered calls. So if I am selling a put option at 13, I'm more than fine to sell covered calls at 13. There's nothing wrong with that. You get put for 13 and then you start selling covered calls at 13. Yeah, you're not getting any capital appreciation on the stock itself, but you are collecting money on the put option and then you are collecting more money on the covered call. And if that adds up to 1% to 2%, well, that's gonna be a lot of money over the long-term period, right? We're all doing this for life. Hopefully you're not, trying to day trade or swing trade or do some of that crazy risky stuff, because I don't frankly believe in that. I believe in consistent cash flow weekly, monthly. And to be honest, I don't always think that weekly is better than monthly. In this market environment, though, right now, I would say that shorter term trading is good because of the Fed meeting and because of other factors. But essentially, weekly trading, I'm doing Airbnb as well, which I was down a huge amount of money on, but I held on, okay? Because I had a belief that Airbnb is overvalued. And I was completely right. Airbnb stock ended up going down a tremendous amount. And for a very long time, my call credit spreads, which is basically a bet again, the stock won't rise. And I have a whole playlist that you should definitely watch. It's my small account playlist. I also have a playlist to grow into $100,000. Both of those playlists, game changing. And for me, Airbnb, again, call credit spread. I am bearish on Airbnb. I think the competition is huge. I think the supply of Airbnbs, there's a lot of them out there, so the prices have to come down, meaning the fees have to come down. And overall, the experience of hotels, I have seen a lot online through Reddit, through personal experience, that there's a lot of competition. So this stock has come down a lot. If you look at the 1 month, yeah, I mean, this was over about $129 per share. And my call credit spread was right at the cusp. It was very dangerous. And I almost wanted to close my position. And a lot of students ask me, when do you actually close a position? For me, it really depends, right? I think that there's different scenarios in the market. If the market is showing a strong bullish trend and you have some bearish positions that go into the money, then it is time to probably close out that trade. However, if there's a strong momentum trend upwards, but say that your strikes are still out of the money, I don't really see a reason to start panicking and getting out of positions early. I really don't see a point of that. What I typically do is I do like to hold until expiration unless the momentum is completely really, really strong against my position, okay? Then tactically, I might take a look at it and say, hey, given the different scenarios, where do I think the stock can end? Is this going to be a severe loss for me? If I think it's going to be a complete loss, I'm going to try to close out for a 25% loss, a 25% loss, a 50% loss, maybe a 75% loss, but I don't necessarily want to go all the way. For Airbnb, I did break a couple of rules. It went way into the money, but I still believe that the market would shift trend, and it absolutely did. And so far, Airbnb actually had a position expire on Friday. That position was down $10,000 at one point, ended up making all of that back because of 1 week. So moral of the story is you definitely want to have a lot of diversification, because when you have many positions, you don't have to necessarily panic about one single position. Although it felt really awful, because $10,000 is a lot of money for anybody, right? Whether you have a 100K portfolio, a 500K portfolio, or $1 million portfolio, $10,000 is a lot of money, and it looked like a loss, but I ended up holding and I ended up making it all back in 1 week. And the only reason I was able to do that is because you guys will see I have so many different positions that I am not tied to one position. I am diversified. I'm not dependent on one position. I have QQQ, SPY, Tesla. Oatly's been freaking killing it. Oatly has been my best small account strategy. So all the students with the small accounts, we're all using Oatly to basically leverage a small account, to really take that small account into a more medium-sized account. I think Oatly is just a great company overall. So word of advice, please watch my small account playlist if you have a small account, or watch the 100K growth playlist, because those two playlists are going to help take your option trading to the next level. Check it out right here.